And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to Tuesday. It is the one day closer to Christmas. I mean, that's like Wednesday of next week. Countdown is here. Santa Claus is coming. 8 days. Do you really count the weekends though? Yeah, I guess so. Yes, you actually do count the weekends. But yeah, 8 days to Christmas, of course. Also, that means that Santa Claus is supposed to come visit Broad and Wall, or you get cold. One of the two. We'll find out what happens over the course of the next few days. But the big news today and tomorrow is, of course, we've got some economic data out today, retail sales. We're going to get a good look at what happened in November. Of course, in November, we had the Thanksgiving holiday and we had Black Friday. So we should see some good retail sales numbers today. If we don't, well, that is going to be a problem. So we'll see what that data looks like. That's going to start to feed in a little bit into expectations for growth in the first quarter of next year. So we'll kind of see how the consumer's doing. I suspect the numbers will be good. So that should kind of give a little bit of lift potentially to the markets today. We'll see. Futures are pointing down this morning. As we talked about for the last few days, we're just wrapping up that portfolio rebalancing distribution process. We were up a little bit yesterday. Going to be down this morning. Just, again, kind of that grind here. Market's just not really done anything here for the last week or so. Kind of exactly what we expected. We're going to get a little bit more into that this morning because this market action is not the same as the sector market action. So we're going to talk a little bit about sectors this morning when we do our Before the Bell wrap. Tomorrow, of course, is the Fed meeting. They're expected to cut rates again. The question is now, will they start to think about pausing rates? The answer is probably not. They may slow down the pace, but they probably won't pause entirely because the Fed funds rate is still too far above CPI. CPI is running about 2.7%. You've got the Fed funds rate at 4.5%. So that's got to come down closer to that CPI rate. So again, we got monetary tightness in terms of the Fed's views is their policy is a bit too restrictive here. So we'll see what they say today, but again, they're probably going to same statement as they've been making before, policy dependent, see how the incoming data is coming in. One of the big stories is going to be in the first quarter in February, we get the next set of revisions for the employment data. Now, this isn't going to matter to the markets, by the way. Markets don't care about revisions, so don't think that this is going to be some big, huge debacle. The markets already know about it because if I know about it and you know about it, the markets know about it, right? Well, in February, there's going to be another revision. Remember, with the last time we saw the revision to the employment numbers, it reduced the level of employment by 818,000 people. We're about to see the next revision in February that's going to wipe out most of the job gains in 2024. So this job growth we've seen over the last year has not really been there, and we're about to get, and we've known that, right? We've known that employment data, these really strong numbers, it's like, this doesn't really make sense from what we're seeing in other data, but okay, that's the number, and that's what the market trades off of. So again, it doesn't matter. The market already trades off, you know, the official reports. That's all they care about. And they don't care about revisions. So when this number comes out and we see a big downward revision to the employment data, don't expect this market to go, oh my gosh, I didn't know that was coming. They know. So that's not going to be the issue. But it is going to be very interesting that a lot of this employment data that we've been looking at, certainly not nearly as strong as expectations. Now, that could feed into kind of the Fed's views as well, right? So they're going to be watching very closely for employment, two mandates, price stability, that's inflation, and full employment. So that's the two things they want. If we start to see real kind of the data starting to come in at a much weaker rate in terms of employment going into next year, that's going to probably promulgate the Fed to be a little bit more steady in their rate cutting cycle. So again, there's some things that are going to weigh on this, but we'll get that report tomorrow. Of course, Thursday with Michael Leibowitz, we'll really dig into all of that. Let's talk about what you need to know before the bell this morning, because the stock market hitting, near all-time highs again. We've talked about this kind of consolidation process that we've been here, for the last, kind of week or so. Market's not really going, they're not going down, they're not going up, but that's that distribution phase that we talked about. And so now the market's kind of getting set up for potentially the Santa Claus rally. That's all the portfolio rebalancing, window dressing for the end of the year. But this story is not the story of the whole market. Let me show you something real quick. So this is the S&P. Looks great, right? Fantastic. All right, let's take a look at basic materials as an example. Ain't nothing good going on in basic materials. Here's your economy, right? So if the economy is firing on all cylinders and we're growing at 3.2% real, basic materials should be doing much better. They're not. Let's take a look at industrials as an example. On the other side of industrials, of course, industrials is all the people that are working in the industry, producing stuff. Not a lot of good data coming out of the industrial sector as well. How about financials? Of course, they had a big run earlier this year. Those have been kind of weak here as of late. We're seeing a bit of a pullback there, so not as surprising. But energy, of course, a main component of the entire economy, tells you another story entirely. Oil's been, energy stocks under a lot of pressure here just recently, coming back to retest some of the lows we've seen this year. Very oversold, by the way, on the energy side. If we get down into, of course, staples, this is stuff that people consume. Really not a lot going on here. Very stable at the moment, but weak. And we're not seeing really kind of the same activity on the staple side that we're seeing in other sectors of the market. Utilities, of course, this is what people consume. Been under a lot of pressure here. Here's the point of the story, is that the only reason the markets right now are trading at all-time highs is they've got to own one of the Magnificent Seven stocks. If it's communications sector, it's Google. If it's in the discretionary sector, it's Amazon. Discretionary is doing fantastic. If it's in the technology sector, of course, it's Apple and NVIDIA, and those stocks are doing just fine. So again, this is a very narrow market. Once again, we have very negative breadth in kind of the market itself. Market breadth is declining across small caps, mid caps, large caps as well. Pretty much you dig into any sector outside of technology, discretionary, and communications, which are the ones that own the mega cap 7 stocks. And again, discretionary is Amazon and Tesla. So those two have been on fire as of late. But that's why the market looks like it's doing great. But in reality, the market's not doing great across all sectors. It's a very, very narrow market. So if you own the index, you're doing just fine. If you're invested in other areas in your portfolio, if you own energy stocks, if you own discretionary, staples, utilities, real estate, those have all been under a tremendous amount of pressure here over the last few weeks. Lots of distribution in those areas, money rotating from those areas into those Mag 7 stocks. But again, this is something we talked about earlier this year. I remember back in the summer, I wrote an article talking about Magnificent 7 stocks aren't dead, and everybody, this is what they assumed during the summer. We had this big rotation to other areas of the market. And it's like, oh, Mag 7's dead. And of course, I said, no, going into the year, Magnificent 7's where you want to be, because that's where your stock buybacks are. That's where your earnings growth is. And most managers were very underweight those stocks in their portfolios. So they've been having to bid those up in their portfolios, sell other stocks to get those weightings up in their portfolio for year end. So that's really what's going on here. But again, watch that breadth in the market. That's something that tells us generally we're getting ready probably in the second month of next year, January, February, likely going to see a 3 to 5% correction in the market. So again, just be aware of that. That's what you need to know before the bell this morning. We'll come back, talk about, I got an email calling me a Permabull. We'll talk about that right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
You're listening to The Real Investment Show.
So interestingly, I get lots of emails from you all the time, every day. Get people emailing, they listen to the show, they hear me on another podcast somewhere. And it was interesting because I got an email earlier this week saying, basically, Lance, you're just another Permabull. This is the email. Lance, you're just another Permabull talking your book. When this market crashes, you'll still be telling people to buy all the way down. That's not true. And if you go to our website and just go back through, and look, this is why. And again, I've said this before on the show. If you're watching our show, we certainly appreciate you being here. But if you're not going to our website, realinvestmentadvice.com, you're missing 80% of the value of the show, because all of our research that we post, or all the research that we do, we turn into blog posts that we post on our website. So either, the 2 blog posts I do during the week, I post one on Tuesday, one on Fridays. Michael Leibowitz posts one on Wednesday. We write the newsletter on Saturday. All that is just how we're researching. So this just has been my process over the years. The way I think about things is I have to put them down on paper. And so when I was doing that previously, I said, well, I'll just start publishing this. When the internet became a thing, we're talking about way back before there was an internet. I just had notepads filled up with stuff. I still have the notebooks in my house.
What was life then when dinosaurs ruled the earth?
Exactly.
That's what my kids ask me. They're like, Dad, you were alive when the internet was born? I'm like, I know. It was stone and tablets beforehand. Chisels and stone.
Exactly. And but again, this is, but so we write all this stuff down. And so if you're not going to the website and reading our blogs and reading the newsletter, you're really missing a lot of value for your time. And again, I get it. We have limited time, but it's there for you. But you go back to 2019, as an example, we were talking about risk to the markets in early 2020. I wrote some articles in January and February called This Is Nuts, and why we were reducing risk. And at that time, I was chastised for, well, this market's clearly going higher. You're an idiot for getting out of the markets. Of course, that was February of 2020. And then, of course, what happened in March. So, but those articles go back, and we haven't always gotten it right by any stretch of the imagination, but we've navigated getting out of markets decently early. And in October of 22, we started writing about articles about why to get back in the markets. In January of 23, you need to be, we're now bullish on the markets. So we've navigated this market. We're bullish now because markets are going up. And but there is a case, and again, I get it, right? Permabulls are people that are bullish all the time. And look, most Wall Street analysts are bullish all the time. Why are they bullish all the time? Because they have product to sell you. If I'm telling you not to invest, I'm like, hey, guys, we're about to have a 5 to 10% correction. You probably want to sell some assets, raise a little bit of cash. And I tell you that all the time. Told you that 3 times this year. That doesn't sell product, right? If I'm trying to sell you an ETF or I'm trying to sell you a mutual fund, I can't sell that to you if I'm telling you to get out of the markets and raise some cash, right? There's also another reason for being Permabull, or being a Permabull. And this is why most analysts, Ed Yardini, Tom Lee, these guys like this, they're always bullish. Why? Because nobody remembers when they're wrong. Jim Cramer was on CNBC all the time. He has never called a bear market, ever. and look, he's been on TV since in the late 1990s, right? He used to run a hedge fund, and then he became a CNBC person. And all through the dot-com crash, all through 2008, he's like, buy, all the way down, right? And even Donald Trump called him out on this on the New York Stock Exchange the other day. But the reason he does that is because nobody remembers that he said buy all the way down. What they do remember is when he said buy at the bottom. Because markets, and here's a chart for you, just to prove this out. This is a distribution of annual returns in the stock markets, right? From greater than 20% to less than or more than a 20% decline. 73% of the time, stocks are positive, right? So importantly, if I'm being always bullish, right, and I'm trying to sell you a product, I'm going to be right more often than I'm not. It's like, yeah, well, last year I only said the market would be up 10%. It was up 30%, but I was still right. I said it was going to be bullish, right? So I'm going to be right 73% of the time. You think about this in terms of baseball. If I had if I was batting a 730, I would be in the Hall of Fame like overnight. So, think about most Hall of Fame baseball players are in the 400s. Maybe the 300s. I was
going to say even the 3s.
Yeah. If you're hitting 400, you're like, you're a legend. But 73% of the time, if you're just bullish, you're going to be right 73% of the time. Now, there's a consequence of the other 27%, and that's why we do try to navigate that as best we can. But we have to realize, and look, there's lots of reasons to be concerned about markets, right, John? I mean, right now we've got stuff going on in Ukraine and Russia. We've got Israel. We've got Syria. You've got a new administration coming in, and there's lots of and you got plenty of doom and gloomers on the internet. It's like, oh, the market's going to crash next year because it's all fake data, right, or whatever it is. Here's a chart of the S&P going back to 1900. Through all of it. Right, every war, every geopolitical event, etc., markets have recovered over time. And look, I'm not telling you, do not get me wrong here. I'm not saying you should just be bullish all the time and just let the wave of markets roll over you. But there are times to be bearish and there's times to be bullish. But you're going to need to be bullish more often than you're bearish. And the reason is that bull markets are a lot longer in length than bear markets. And this is the thing that traps up the bears, or trips up the bears more often than not, is that bull markets last longer and go farther than you expect. The average bear market's about 5.5 years. Sorry, the average bull market's about 5.5 years. So they can last a very long time. We've had bull markets that lasted 148 months, 131. That's a very long time. Bear markets, on the other hand, I'm going to switch charts on you, Brent. Bear markets, on the other hand, are generally event-driven. They generally coincide with a recession, and they're fairly short in length. And then you're back into a bull market. And so this is why most Wall Street analysts are kind of perma-bullish all the time, because their kind of view is you can't really predict when the bear markets are going to come, and you can't. because they're event driven. As I said, they're event driven. So as investors, there are some things we need to be paying attention to navigate that potential risk of an event driven market. And again, as investors, we're going to be reactive to bear markets more so than being reactive to a bull market. And what I mean by that is that you're going to be long a bull market, and then something's going to happen, and you're going to recognize that the bear market has now come, or the correction has now come, and then you're going to react to that. So it means you're not going to sell the top, and you're not going to buy the exact bottom. But you're going to get out a little bit late, and you're going to get in a little bit late. But you're going to navigate that cycle of the market. And there's some indicators that can tell us that we're getting kind of close to the next event-driven market. Because why is there an event-driven market? It's because markets get out of balance. Everybody gets on one side of the boat. Everybody's very bullish. And then some event occurs that causes the crowd to go to the other side of the boat. And that's how you have this event-driven kind of outcome. And you can't have that. If everybody's bearish, you can't have a bearish event, right? Because everybody's already bearish. So events have more impact to markets when everybody's lopsided in the boat. And here's a chart of this. Continue, Brandon. I'm going to change charts. Technically, we can see this. And again, this is why technicals are so important. Now, this is a suggest that you're going to have at some point in the future, and here's the problem, right? At some point in the future, this kind of mean reverting event. You have
Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Show your love this Christmas by giving a used gift to somebody you love.
Nothing says Merry Christmas like a 2005 big screen TV.
Merry Christmas to you too, you little freak. On a roll this morning. Anyway, I may be divorced by the time I get home. It's better than stimulus.
Listen to the Real Investment Show podcast from your favorite service. Same show, your schedule at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Can you hear me now? It's like a Verizon commercial. We were having some audio difficulties. Apologize for that. Brent crashed the car this morning. So
It's all the drones.
it's the drones.
It's the gremlins.
Yeah. So
It's that time of
apologize.
year.
Apologize for the volume issues, but I think we've got it fixed. So just let us know. Carl says he's now suddenly deaf. Ha! That gets you.
You get your hearing aids for Christmas now. Sorry about that.
Okay, so anyway, just wrapping up that conversation. This is why when we talk here with you every morning and we discuss markets, and this is we're not bullish, we're not bearish. We try to just navigate the markets for what they are, and we do realize that there's going to be a turn in the markets at some point. We've got to navigate that, and but that and that's difficult to do, right? But it's not impossible. It just takes some work doing it. And again, you have a choice. And again, this is kind of the way that the market has evolved over the last 15 years, is that this market's just been kind of at this incessant rise. And now everybody's just like, well, why even worry about that? Just buy an S&P index and just, write it up. And yeah, you have 35% decline here or there. Big deal, right? It comes right back because the Fed's going to step in. They're going to bail stuff out. They're going to do QE, whatever it is, and markets are going to rally again. So why worry about it? I get it. And as long as you have enough time, if you're young, right?
Sure.
You're in your 25, 30, just, buy an S&P index fund, dollar cost average into it every month, and just go on your merry way until you retire. You'll probably be fine. The risk comes to you're now in your 50s, and you have a 30, 40, 50% decline in the markets, and then you spend another, 5, 6, 7, 8 years getting, you're not ready for retirement yet, but you spend all the time between that point and retirement just getting back to even. And so you lose 5 to 10 years of return times to grow your money. And so it's when those crashes, I shouldn't say crash, because that's really a misnomer. Markets don't crash except when you have something like a financial crisis, right? Which is a fairly rare event. But you do have corrections along, and fairly sizable corrections along the way. So, that's going to be kind of a normality going forward. And so, we have to navigate that, particularly if you're older in life.
Yeah, I mean, like our oldest daughter, for example, great. I mean, she's 24. Started her first post-college career, helping her with her retirement plan. She is all Roth 401k, by the way, all Roth 401k. Pay the tax now, young, setting herself up for 10, 20, 30, 40 years down the road. And she's like, Dad, what should I invest in? I said, just keep it easy, Standard & Poor's 500 index. And earlier this year, July, August, when the Standard & Poor's was pulling down by 8%, she's like, Dad, what's going on? And everybody at her office, all these, as I like to say, young kids that she's working with, they're all, freaking out. Markets are down 8%. I said, don't even let it phase you. I said, you're buying shares. You're going to buy more. Just keep buying more. Don't, at this stage in your life, just let your money work. If the market pulls down, guess what? Things are on sale. Well, now let's fast forward to when you're in your mid to late 50s. What if you're in your 60s, right? Let's say markets have a more egregious pullback. At that stage of life, I typically find out that folks are more concerned with, fear of loss versus, trying to get all the gain. And it's that math of loss that we talk about, right? If you're, for some reason, depending on what the market does, I find that folks are more concerned about taking a 50% loss. Not saying that will happen, but as an example, if your portfolio is down 50%, you don't have to make 50% to get back up to break even. You got to make 100. And that's where the math of loss can really kind of throw a curveball at you, right? So in the first segment, Lance, you were talking a little bit about, markets and how we help folks, kind of get in or get out, or how we help rebalance portfolios and manage risk over time. So I wanted to spend just a little bit of time on that, because when we say get in or get out, we're not completely out or completely in. We're not an all in or all out. So, but we kind of manage the risk of what is our exposure to equities, to bonds, to cash over time. So can you elaborate a little bit more on that?
Yeah, I mean, so part of the and this is the mistake that people do make, right, is they try to time the market.
Right.
And so I'm going to be all out. And that's okay. If you can get the timing right, that works well. The problem is getting the timing right consecutively. And I've talked about this before on the show, is that I learned a really valuable lesson back in 2008. We'd gotten out of the market in June of 2008. So before the market crashed, we had gotten out. And it was entirely out, and I was just long treasuries. And the market crashed. Well, everybody was happy with that, but the getting back in part was more difficult than I thought, because in February and March, I started talking about, hey, we need to get back in the markets and all this. And clients were like, no, I don't want to be in the markets. This market's going to zero, right? And so I learned a lesson that you can't go to no equities.
Right.
You can get very defensive in your equity. So I can have a lot of equities that are dividend yielding stocks, good aristocrats, and they're going to catch some money flow. Yeah, they're going to go down in value some, but they're going to be there, and they're not going out of business. So you own your Exxon Mobils, you own your Apples, those type of companies, and they're not going to go out of business. So that way, when the market does start to recover, you kind of have a foothold in the market. So now all you have to do is just start adding back to your stocks, and you can see the recovery. You say, okay, now I see these companies are coming back. I'm making some money here, so I can start adding that back to that. So, and that's kind of where we came up with, kind of how we break our portfolio down, which is when you get, and again, when I showed you that chart earlier, the big quarterly chart, when that thing begins to break and we begin to get our initial sell signals on those longer term charts, we'll reduce our exposure and say and just for example purposes, we're talking about a 60-40 portfolio. Yeah. Well, so what happens is when that break starts to occur, money's going to leave risk assets and go to safety. So they're going to move to treasury bonds at that point for safety. And they're going to sell corporate bonds, they're going to sell muni bonds, they're going to sell high yield bonds for sure. And that's all going to shift into treasury. So that, because now your credit spreads are going to start kind of breaking to the upside. So we'll reduce our equity exposure by 25%. So you go from 60% equity to 45%. Now, as your next set of signals begin to break, suggesting this is more than just a correction, you go from 60% to 50%. So now you're at 60% stocks, you go to 30% stocks, increase more of your bond exposure. The most extreme you'll get is like now your final, there's 3 sets of signals that when they kick in, we'll make these adjustments. So when that third set of signals kick in, we'll get down to 15% equities. So you've reduced your equity exposure by 75%, but you don't reduce that exposure anymore. You're going to stay at 15% equities. Yep. Now, think about this for a second. If you only have 15% equities in your portfolio and the market declines by 10%, you're down 1.5%. You can live with that. That's okay, right? That you're going to be down. It's okay, but you've got bonds now in your portfolio that they're pulling up. They're going up in value because of the risk off rotation. They're also throwing off a dividend income or interest income on top of that. So it's going to offset whatever 1.5% decline you get for every 10% decline you get in the portfolio. But that way you still got that foothold. So once the market begins to turn and those signals begin to reverse, so now they're going from sell signals back to buy signals. When the first sell signal goes back to a buy signal, you start adding exposure. So you go from 15 to 30. Second one kicks in, 30 to 45. Third one kicks in, 45 to 60, and you're back in the ball game. Again, you're going to be late getting out because those sell signals are going to lag the actual turn. And you're going to be late getting back in, so you're not going to buy the bottom. Because It's going to take time, because these are quarterly signals. These are monthly signals. They're going to be slow to turn, but that's okay, because what I want to know is that the bear market is over.
Yeah. And it's as nimble and as flexible as that approach is, it's not that the portfolio can avoid a drawdown.
Right. We
We just don't want the portfolio to come down anywhere near to what the market might be doing, because we don't want that to derail you, right? But I can't tell you how many times I see, Lance, still where folks are trying to perfectly time, okay, I'm getting out now, I'm going 100% to cash. How many folks did that back in the great financial crisis, and they've yet to get back in? Right. And look at all of the opportunity that you've missed along the way. So if you would have just kept some of your money invested and working throughout that period of time, would it feel good? Probably not. But looking back, your money would have worked a lot more for you, a lot harder for you than if you would have just been kind of sitting out on the sidelines waiting for the perfect time to go back in. Mm-hmm. And so many people are waiting for the perfect time to go back in. And still now, as we get to the end of 2024, there are a lot of folks who've missed this market this year. There are a lot of folks who missed the market last year too. And now they're trying to predict, well, what's going to happen in 2025? Is it going to be the big one next year? Well, I'm just going to wait. I'm going to wait for the market to make a really big pullback, and then I'm going to go all in.
Yeah, no, it was interesting. Here's a good example. It's all about psychology, right? Mm-hmm. But really good example of this is I talked to a lot of people right before the election, and they're like, I'm not doing anything until after the election. I want to know what's going to happen with the election, and once I know that, then I'll be ready to get in the markets. I'm like, okay, no problem. I get that. Right? We could have a contested election. We could have a whole variety of things. After the election, I talked to the same people, and I'm just going to wait to see what's going to happen after Trump gets inaugurated, right? And we'll see what policies get passed, tariffs, whatever. I get that. The problem is there's always going to be a reason to wait.
Yes.
Right? And this is always like, well, I'll do it tomorrow. Well, tomorrow actually never comes, right? So, at some point you kind of have to just make that decision saying, okay, I'm going to get invested and I'm just going to navigate kind of the market from here. And that's the best you can do, right? In order to get to any destination, you've got to get in your car and start driving that direction. Stuff's going to happen along the way, right? Roads are going to twist and turn. There's going to be some accidents to avoid, some road hazards.
Houston, there'll be potholes.
Houston's will be potholes. Mm-hmm. But you navigate them, right? And then you get to your destination. The difference is whether you're driving 150 or driving the speed limit. That can make a very different outcome to whether or not you get to your destination on time. All right, quick break. We'll come back. Get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
We were just talking about beards on the break, and
Real exciting stuff.
But beards are in fashion now because men have just gotten lazy. It's like, look at my cool beard.
Hey, what are you saying, man?
I don't have to shave every morning.
What are you saying?
I'm saying you're lazy. I shave
lazy.
every morning. I get up and shave every morning, even on weekends.
It still takes, you got to manicure this. Otherwise, it turns into like a weed patch. You don't want to be coming in looking like Grizzly Adams. I can tell you that right now. And the only reason I had this is because my wife likes it.
Really?
I've never used to grow out a beard.
Really?
And then there was, No Shave November a couple of years ago. Yeah. And so I started, she's like, oh, I kind of like that. And I was like, I was ready. I had the razor ready to go. She's like, no, just go ahead and keep it. And there it is.
There you go.
Yeah.
So she likes the scruff, huh?
She likes the scruff.
She likes the road rash.
She does.
Okay.
Yeah. I still have to maintain it. Just saying. Yeah.
How many days a week do you work on maintenance?
Probably every other day.
Really?
Yeah. I have to shave my neck every morning.
So like 3 days a week, you're lazy.
Oh, see. I'm in a lose-lose here, folks.
Anyway. It's all good. The 4-day growth look is in.
Feel the love.
So, all right, real quick. We got a question. So there's a lot of ways to kind of save money and invest. And once you become a higher income earner, things become a bit more challenging. And if you're listening to the show, as we've talked about before, if you don't have any money, you're probably not listening to a financial talk show at 6:45 in the morning, right? And so, I mean, obviously you're listening to the show because you've got money invested, you've got a retirement account, you're contributing, those type of things. And, tax efficiency, we talk about, Roth IRA conversions. And by the way, today is, what is today? The 17th. If you haven't done your RMD yet for the year, your required minimum distribution, you have to get that done before the end of the year. Don't wait until next week to do it because everybody's on vacation. Banks are, you're going to have bank closures. You're going to have, backlog. And there's a lot of people that do wait till the very last minute. It's like, oh my gosh, I got to do my RMD. Don't wait till the last second because if you miss the end of the year for whatever reason.
Yeah, and if you get audited, you're going to get penalized.
Yeah.
Yeah.
So do your advisor a favor, do your banker a favor, and do your RMD. Like, go do your RMDs today, tomorrow. Get them over with.
Yeah, and if your advisor has been calling you to remind you about taking your required minimum distribution, please call them back so they can do it. I'm just going to put that
hint,
out
hint,
there.
wink,
Hint,
nudge,
wink,
nudge. Yes. Yeah, we call all of our clients and say, by the way, you have to get this done. But anything you need to get done before year end, please do it now. Don't wait until the last week of the year. This is for advisors. This is tax season for accountants. It's just our busiest time of the year. please help us help you. And not when I say us, it's ubiquitous. Us, all advisors help you, get your stuff done before the end of the year. But talking about that is that, once you start getting into higher income brackets, contributing, $25,000 a year to your 401k plan or, $6,000 a year to an IRA account is really just kind of a drop in the bucket. And so trying to find some ways to defer taxes. And one of the questions comes up is like doing a backdoor Roth IRA conversion. And you can do that, right? But there's risk to it.
Yeah. So around this time of year, and because we talk a lot about Roth IRAs and Roth conversions, right? Especially for folks where your modified adjusted gross income is too high, you're not able to make a straight contribution into a Roth IRA. So let's talk a little bit about a conversion. Well, there is this what is called a backdoor Roth IRA conversion out there, and there's a couple things that you need to watch for with this. And we start to see this a lot around this time of year, where folks are like, "Hey, I want to make a backdoor Roth conversion is this: you make a non-deductible contribution to a traditional IRA. So you're putting money into a traditional IRA. Let's say you're 50 years old or older, or as I like to say, 50 years young or over. You make an $8,000 non-deductible contribution to a traditional IRA, and then you immediately convert that $8,000 over to a Roth. That's how you're getting that money into the Roth kind of through the back door, right? Because as a high-income earner, I can't put my contribution straight into the Roth. I've got to go make a non-deductible contribution to the traditional IRA first, and then immediately convert that money over to the Roth. Well, here's what folks can run into if you're not careful, and it's called the IRS pro rata rule, or you may hear it called the cream in your coffee rule, right? The cream goes in your coffee, and then you can't get the cream out. Everything's commingled in there. So if you make a non-deductible contribution into an IRA where you already have deductible contributions in there, you don't have a way of then segregating out those non-deductible contributions to go to the Roth. So basically, your deductible contributions and your non-deductible contributions all become the same, right? And so what investors try to outsmart the IRS. They said, well, IRS, I'll show you. I've got these traditional IRAs, SEP IRAs, simple IRAs out there where I've already made all these deductible contributions into. So I'm just going to open up a separate traditional IRA that's separate from all of that. And I'm going to make a non-deductible contribution to that separate traditional IRA and immediately convert that money into the Roth. Well, the IRS figured this out. So it doesn't matter if you have one traditional IRA, two, a SEP IRA, a simple. The IRS views all those IRAs as one, as one and the same. So if you think about it this way, let's say you have a traditional IRA where you've made non-deductible contributions of, let's say, $92,000 into that traditional IRA. You've made deductible contributions of $92,000 into that traditional IRA. You make a non-deductible contribution this year of $8,000. So what does that bring your total IRA balance up to? Now you're at $100,000. Well, of that $100,000, $8,000 is non-deductible, or 8%. So when you convert that $8,000 non-deductible contribution over to their Roth, 92% of that conversion is going to be taxable. And so it works against the whole thought about trying to do this backdoor Roth to begin with. And even if you convert this money to the Roth, you still have some non-deductible contributions in your traditional IRA that you need to account for moving forward. So in the future, when you start taking withdrawals out of your traditional IRA, some of those withdrawals will be taxable. Some of that withdrawal will be tax-free. You got to keep the record keeping on that.
And it gets worse than that, because if you have that invested in dividend yielding stocks, the dividend income on the non-deductible portion of the principal is also non-deductible.
Right.
It gets really bad really fast.
And it's not so bad. And it's difficult for you to keep up the record keeping. But then when you pass on, well, guess what? Your beneficiaries have to deal with this too, including your children, if they inherit a non-spouse beneficiary. So all this kind of goes back to what we were talking about earlier too in previous shows was, sometimes folks want to have a diversification of accounts and they have IRAs at several different brokerage firms. It's easy to forget that you have a traditional IRA or a SEP IRA or simple somewhere in place that you've already made deductible contributions into. So you got to watch. So in short, You just got to watch out if you're trying to make a backdoor Roth conversion. Watch out if you have other traditional IRAs, SEP IRA simples out there where you've made deductible contributions into them. You're going to be subject to the pro rata rule.
Right. And look, honestly, I mean, you're making you're making a contribution that you're paying tax on now.
Yes.
Right. For me, a better way to do that would be to buy a whole life insurance policy and overfund it, because that overfunding grows tax-free. Your withdrawals are tax-free. It's like a super Roth, because now I'm not limited to $8,000 a year. I can put as much, I can put a lot more into them. There is a limit,
right,
depending on, kind of how much insurance coverage you have. But you can overfund that policy, and you can set it up in a way that you can overfund it, and it grows tax-free. And your withdrawals are tax-free, and it works better. It's kind of a hassle to set up, but once you get it set up, it's actually a much better way to do it. And it's easy to keep up with, and it's judgment-proof.
Well, and what you're talking about is, having a diversification of accounts, different pools of money that you can pull from as you get a little bit older. So that way you can control your income taxes as you're a little bit older. If you've got a high, income year, and you have money in Roth, or if you have this life insurance policy that has a cash value component of it, you're right. You can borrow against the cash value. It's like a tax-free loan. Right. And that's another way where you can kind of quote unquote tap into and have some, tax-free income and help you control your tax bracket as you're a little bit older. Right.
Yeah. No, absolutely. But again, this is just, there are ways to manage your tax risk, and you just need to be smart about it, because again, a lot of these things that I see, and again, backdoor Roth conversion, I've seen that promoted on the internet a lot. Sounds really simple on the surface until you get the letter from the IRS.
Yeah.
And then it's not worth it anymore, because again, it's not that much money. I mean, if you can only do $8,000 a year, it's like, are you really doing, for the risk you're putting yourself at in terms of potential tax issues, IRS audits, et cetera, by the time you pay your accountant to sort it all out, or your tax attorney to sort it all out with the IRS, you won't have saved any money. So sometimes simpler is better, and sometimes simpler is just pay the taxes now.
Yeah. And here are other things that I find too, because we're coming right up on tax season right around the corner, when folks are looking to make a deductible contribution to a traditional IRA. If depending on you can always make a contribution to a traditional IRA. The question is, can you deduct it or not? And depending on your income, and if you are what is called you are an active participant in your employer-sponsored plan, 401k plan, 403b, you may not be able to deduct that contribution that you make to a traditional IRA. So all these wonderful tax fund things that we talk around this time of year and going into the beginning of next year.
Exactly. And Eric commented and says, I don't like the IRS. Eric, nobody likes the IRS. All right, wraps up the show for the day. Be back tomorrow with Danny Ratliff. Thursday, we'll have Michael Liebowitz talk about the Fed. Next week, we're off, but we will have podcasts for you all week. So if you go to our website under the resources tab, click on our podcast link, you get all of our podcasts right there for you. They're also on Spotify, Apple, iTunes, etc. Whatever your favorite podcasting app is, it'll be there for you. realinvestmentadvice.com. See you tomorrow.